Good afternoon, ladies and gentlemen. Welcome to this special show of Market Guru, where you get to meet the finest brains on the Lal Street, people who've made supernormal money for their clients, for their shareholders, and have done phenomenally well, whether it's a bull or a bear market. Our guest today is Mr. Sahil Kapoor. He's the market strategist and head of product development at DSP Mutual Fund. Namaste, Sahil ji. A very warm welcome to you and good afternoon. We welcome you at a time when Nifty is celebrating its silver anniversary, and we have all sorts of fabulous momentum across the board, whether it's pharma, whether it's FMCG, whether it is other sorts of asset classes which are making supernormal money for their shareholders. I just wanted to understand, is making money and finding out the right multi-baggers become a little difficult for market strategists such as you? How are you now treating this rally that is unfolding in front of us as the festival season begins?
Sure. Thank you for having me on the show. So first thing is, you're right, bargains are becoming difficult to find. And the reason is that a large part of listed universe, when we talk about equity, are trading at valuations which are unprecedented. For example, when you look at the top 1220 companies, which is the all market cap index from BSE, you will see that more than 50% of those companies are trading at multiples of 40 times or more in terms of trailing 12-month price to earnings ratio. So these are the numbers that we haven't seen in the past. Also, we are seeing some unprecedented numbers in terms of volatility, which you pointed out in terms of market gains. So I will tell you that currently we are in the 53rd month where stocks haven't seen a 5% or bigger decline month on month. So it tells you that it has been a smooth run. Markets have been rising at a very smooth pace. But from a valuations perspective, it does appear that we are slightly overstretched.
Fair point. And for the last 5 years or so, we haven't had a decent correction. For the last 9 years, on each successive year, the Nifty has closed higher than its previous year. This is a fantastic space to be as far as existing shareholders are concerned. But Sahilji, the thing is that lakhs and lakhs of new investors are now coming into the market, and it is critical that they have a good experience when they start their journey into investing in this lovely bull market. How do you suggest that new investors look at this market in terms of expectations, and where should they be putting their money?
Sure. So first thing is that they should be cognizant of the fact, and I want to emphasize the word that you used, existing investors. So the returns that they are seeing today belongs to investors who invested 10 years ago or 5 years ago, right? Which means that to expect the same kind of return is slightly out of place. So that is the starting point where you need to get the expectations right. So for example, no market in the world has delivered high double-digit returns if the starting valuations were more than 23 times where we are trading today. So first starting point is to tone down return expectation. Second, also to look at other attractive asset classes where possibly the assets are not as overheated or they are in low cycle. That could be another important ingredient. For example, adding a flavor of debt securities, adding a flavor of gold and silver to your portfolio, or some global equities to your portfolio. That could be a good multi-asset kind of an approach. I think that could be a very good starting point. Third, if investors are uncomfortable with other assets and want to stick to equity and debt, then possibly looking at equity savings as a category or a dynamic asset allocation as a category. I think these are good starting points for investors today. And within equity, our orientation is to look for large caps. We think that the margin of safety is much better in large caps versus rest of the market. And in fact, within large caps, we would be we will have better margin of safety in the largest cap companies, which are the large cap of the largest. So I think that is where the comfort will lie.
Okay, that's an interesting point you make. If you look at the Nifty 50 companies, ever since COVID began, Mr. Kapoor, they have sort of concentrated the profit growth within themselves, while mid caps and small caps have actually delivered far higher returns. Large caps have made more profit. Relatively, they have underperformed mids and smalls. Is there some kind of an inflection point happening in India where maybe the top 25 or maybe the top 50 or maybe a smaller set of companies will get bigger and better? And if yes, how should investors take advantage of this mega trend?
So I have Bob Farrell's 10 investing rule, which is stuck on my notice board on my desk right now also. And one of the rules says that there are no new eras. Okay. And the stock market is known to find new eras. We more often than not see that there will be periods where we'll think that something new is happening. For example, that some set of companies will have extraordinary growth, but one thing is that if the profit growth lags for a sustainable period of time, stock prices will come back, right? You cannot sustain stock price performance only by having your multiples expand, which means only by increased valuations, the performance does not sustain. So profit growth has to come, and wherever it will come, I think those pockets will be rewarded. As far as this, dichotomy goes, why small and mid caps have outperformed, there are two reasons. One, from the COVID bottom, small and mid caps had relatively cheaper valuations, right? Because they had two bad years, 2018 and 19, and then COVID happened. So you had large decline of more than 50% in large number of names. So the starting point was more attractive for most of these companies. And second thing is that uh, at times market feeds on itself, expectations feeds on themselves, and people begin to believe that extraordinary periods of returns can continue. So I think that has caused some expansion in multiples for smaller companies. But having said that, larger companies, so let's take the large 10 companies, they continue to make 25% of all free cash flows generated in India. So there are about 4,000 listed companies. Just 10 of them make one fourth of all free cash flow. So we cannot ignore these numbers. And I think eventually companies which make more profit and make more free cash flow, they will be rewarded over time. And therefore the tilt
Yes.
towards the largest cap.
Okay, Mr. Kapoor, let me just take this conversation a little forward. We have seen within the 10 largest companies, at least four of them doing absolutely nothing for the last 4 odd years, even though their financials have improved dramatically. I mean, in some cases, net profit has almost doubled, but the parent, whether it is HDFC Bank or Hindustan Unilever or Kotak Mahindra Bank, or to some extent some other top 10 companies, they haven't done anything for shareholders, maybe because in the decade before to the stagnation, they performed very well. So, how do you suggest investors now tap into this potentially large gold mine of returns? Should they look into Nifty ETFs, or maybe DSP has some fund which is focused 10 or focused 25? What is your view?
So first thing is that, of course, we think, as I said, largest cap companies. So when I talk about largest cap, I'm talking about the top 10 companies. So there is a NSE index called
Yes.
Nifty Top 10 Equal Weight Index, and DSP has a fund on it, both index and ETF. DSP Nifty Top 10 Equal Weight Index and ETF, both are available. And why this? But as you said, four companies, and let me highlight it. This index has four banks, right? And these four banks, are more attractive. So when you look at the complexion of the market today, banking is the only space available to you at average or below average valuations. Everything else in the market is slightly above average or extremely above average. For example, look at the Nifty. Nifty is trading at 23, 24 times trailing earnings. If you remove the BFSI sector, X of BFSI, Nifty trades at 28 to 29 times trailing earnings. When you look at the BFSI sector alone,
Correct.
X of Nifty, it trades at 17 times. So that is the kind of gulf which has opened up, which makes this segment a lot more profitable. And one more stat I will probably tell you that when you look at banks, when you put them all together, their market cap versus Nifty 500. Okay, so their share in market capitalization in Nifty 500 is at 12%, which is a decadal low
Yes.
versus their profits within NSE 500 is at 25%, which is all-time high, right? So I think that these stats tell you that there is a pocket in the market which is slightly undervalued, probably relatively better placed, and the top 10
Hmm.
stocks give you 40% exposure there. Plus, of course, there are other good companies which does not have price froth. So I think this kind of a concentrated strategy can
Hmm.
help investors perform relatively better.
Okay, and this fund was launched fairly recently, maybe in September. So we'll await the portfolio. But this is something which is wonderful. If viewers want to take a very concentrated exposure of just top 10 companies by market capitalization in India, then DSP Nifty top 10 equal weight fund and ETF, possibly available at 10 rupees, is the best product. I would imagine, Mr. Kapoor, this would be equal weight. I mean, whatever are the assets that the company has, each stock will have 10% weightage. Am I right? Or would you be replicating the Nifty weight of top 10 market caps?
No, this will be equal weight. As you said, all 10 stocks will be equal weighted. At the end of each quarter, there will be a rebalance where all 10
Okay.
stocks will become equal weight. And so it will continue to be a equal weight portfolio
Hmm.
forever. And as you know that we also introduced the Nifty 50 equal weight strategy 6 years ago, and that was Nifty 50 stocks, 2%
Hmm.
each. And that strategy did extremely well, outperformed almost everything else on the street. And that was the time to diversify. Today is the
Hmm.
time to concentrate. And that's why we've launched this top 10 index.
Okay, this is a wonderful fund that you talk about, which is the Nifty 50. 26 rupees 65 is the net asset value, and I'm just looking at the return since launch, which is 15.3% CAGR. The launch date was October 17th. Okay, so it's 3 plus 4, 7 years, and each year the fund has compounded 15.3%. Of course, you've handsomely beaten the Nifty. So let me just get this right. Suppose Reliance were to rise 2.5 percentage points in terms of actual value, then you will trim Reliance once the rebalancing is done and get it around 10%, and whatever stock has underperformed or has fallen below 10%, you will get into that. Am I right?
Absolutely. So it's like a automatic profit booking strategy, where you sell the outperformer, buy the
Okay.
underperformer. And why it works well is that equal weight strategy has been in force for over 60 years now, right? And it works well because it is sort of a mean
Yes.
reverting strategy, but you continue to hold a very solid portfolio,
Hmm.
right? Where companies do well over time. And therefore, I think it gives you a very good flavor of compounding with consistent profit booking. And because it's a mutual fund format, rebalancing does not attract any taxes. So that is an added
Yeah,
advantage.
you pay less. Absolutely. And I stand, how should I say, educated today. I'll do a deep dive into the DSP Nifty 50 equal weight fund, and maybe do another show on that. Mr. Kapoor, let's look at the broader markets across the globe. September is probably a seminal event where Wall Street will see rate cuts happening after maybe 4 years or so. How do you see this panning out in India? Should we be following suit? And if yes, when do you expect the first rate cut to come in?
So first thing is that it's quite possible that Fed moves by some amount, maybe 25 basis points or so. That is what it has indicated, that it will try and cut interest rates. Domestically, I think India and many other emerging market central banks have been waiting for Fed to move first and then embark on a rate cut cycle. And when you look at the domestic numbers, our core inflation is at 3.25%, which is almost a 30-40 year low, right? And barring, let's say, food inflation, which is slightly more volatile, inflation doesn't seem to be a problem. Government borrowing is also not a problem because government is now borrowing lesser than what it was doing last year or year prior to that. Third is that our balance of payment is also very stable, so we don't have any external shock coming up as of now. So I think RBI has some elbow room to cut interest rates, but how large the rate cuts will be decided by why the rate cuts will happen. So if the Fed cuts rates by 25 bips or 50 basis points, I don't think it will be material because markets have already moved up in anticipation that rates will be cut. Financial conditions have already eased in US. So I think it could most likely be a non-event unless the rate cuts are very big, that over a 1 year period you see 200 basis points rate cut, which to my mind cannot happen without a crisis, right? So the most important question that comes to my mind is why will the rates be cut? I think that is the question that only we will know only in future. And if the answer is because of a crisis, then I don't think it will be good for equities. But if you have some mundane 1 or 2 rate cuts, I don't think they will make any material difference.
Nevertheless, I think nobody in India is listening to anybody else, but just continuously pouring money into systematic investment plans that makes lives for individuals like Mr. Kapoor very easy in attracting money. But the difficult part starts when you have to deploy that money in sensible areas. Sahilji, let's look at some other interesting segments of the market which have shown remarkable traction. One is this aspirational consumption space where this booming how should I say ultra rich Indians have invested, whether it is larger houses or better homes or bigger cars or jewelry, so on and so forth. They've made supernormal money on markets as well. Is this a theme that DSP Mutual Fund finds exciting? And if yes, is this theme still worth investing into?
So first thing is that your assessment is absolutely right. If I may name it as the premium segment, it has seen a very strong traction, right? And post-COVID, we saw sort of a hedonistic consumption demand where people came back and said that we want to consume more now because for almost 2 years the consumption doors were shut. So there was a big revival for things you pointed out, and plus including, let's say, tourism and traveling. All those numbers came out very, very strong. But our sense is that some amount of this is now tapering, right? And why do I say that? If you look at the wage growth for white collar workers in India, so I'll put like 3 segments. So IT and ES, auto ancillary and autos, and BFSI. These 3 sectors account for more than 2/3 of all white collar wages and salaries in India. And over the last 4 years, their CAGR growth in salaries and wages for employees has been 14% or more, which is one of the strongest numbers we've seen in a very long time, right? But these numbers have now started to slow down. Particularly in the IT and ES space, the numbers are now in low single digits. So our sense is that some of these numbers, which have been very strong, could now normalize, go back to pre-COVID trends. Our overall growth is now just about 7% on private consumption, and those numbers are not very strong. They are actually below our long-term average growth rate. So one sense is that the K-shaped recovery, where the upper end was doing extremely well, is now normalizing, while the lower end that is beginning to improve, but not at a fast clip. So in fact, what we see in data is that the K shape is now normalizing adversely, which means that the upper leg of K is now coming down while the lower leg is rising at a much smaller pace. So we'll be slightly more cautious in terms of how we approach consumption. We are happier looking at more non-discretionary consumption like staples and pharmaceuticals and healthcare, where we think that the trends could be more persistent.
Yes, and that automatically, Mr. Kapoor, brings to me the next question. Rural demand after this fairly good monsoon across the country has shown signs of uptick, and that's visible in stocks like rural plays like Dabur, Hero Motors, to some extent Hindustan Unilever as well. Is this a trend here to say? The reason why I ask particularly on Hindustan Unilever, that it is amongst the top 10 in market cap, and the stock hasn't done anything at all when it comes to returns over the last 4 years. So a prime candidate for reversal and future gains. What do you say for rural demand?
So we made this similar assessment at the beginning of 2024. In fact, in Feb report, the DSP Netra report that we write, we highlighted that there was a consistent commentary from a number of staple companies that growth is not happening and there are no green shoots. But January and Feb, we started to read some of the companies diverging in commentary, where some companies were saying that they are now seeing green shoots, that there is some recovery happening. And that was the first point where we raised our weights and our stance on this sector. But let me tell you that we will still wait for this data to come, right? We want to see hard numbers going above 5 to 6% growth, and that growth itself will not be enough, right? So one is that on a relative basis, it does appear that this is a safer place to hide in how markets are placed today, which is the staples and FMCG sector. But on an absolute basis, can their growth rates go back to the good times? We still find it tough to see that in data. So it hasn't turned up in data. So we'll have to wait and see how these numbers improve. If they improve, I think, yeah, these stocks could do very well. Otherwise, I think they will relatively outperform the market, but absolute returns could be limited.
Right, and before we call it a day here on the show, Mr. Kapoor, since you are the numbers man at DSP Merrill Lynch, would you just guesstimate where the Nifty could be 1 year from now, provided all other things remain the same?
That is a question that I don't have the ability to answer. I mean, forecasting where the index will be is, I don't think that there is a scientific way of doing it. But all I can say is that there is a good probability that could be lower than where you are today, likely because valuations are very high. But as you know, that markets have their own mood, right? Their own sentiment. They can do whatever they want to. So I will not hazard a guess on the index level. But I think you are more, it will be more prudent to be more conservative in approach today and look at it market from a more risk perspective and look at margin of safety over returns.
Okay, would you imagine that this dip in crude oil prices below December 21 lows is some kind of an indication that the global growth engine is slowing, and you just might feel its impact on Indian shores as well?
So I think the first indication came way before, because crude oil forward curve started to lose its backwardation. It went into contango at many parts in the curve. And that was the first signal that demand is weakening for oil. It could have been either because of higher supply also. So you can't really make that assessment because it's a demand supply curve. Second thing is many other commodities like a copper also lost a lot of backwardation, which tells you that there is a slackness in terms of demand, which is, creeping in. And I don't think it's a surprise because the largest consumer of commodities, which is China, is struggling for growth, right? So these two data points match with each other, and I think it indicates that global growth is slowing down. What is the extent of the slowdown? Only time will tell, but yes, it's an indication.
Right, with that, Mr. Kapoor, we'll call it a day. Thank you so much for giving us this opportunity to dig deep into your brain and find out wonderful ideas and themes for investment. For sure, we'll be looking at the Nifty Top 10 Equal Weight Fund, which seems to be a wonderful instrument to catch into relatively lower valuations within Nifty and at the same time having superb quality stocks in the fund and your portfolio. Thank you so much for your time. It was wonderful speaking to you, sir.
Thank you very much. Thank you for having me.
That, ladies and gentlemen, was Mr. Sahil Kapoor. He's the market strategist and head for product development at DSP Mutual Fund. He spoke about two products which are, in my mind, a wonderful theme to look at. The top 10 large cap companies of India in terms of market capitalization have been bunched together in an equal weight format with DSP Top 10 Nifty ETF, which is an equal weight fund. We'll try and do a deep dive into it once the portfolio comes out, but this is something that you can look at. This is a fund that was launched in September alone and is available in the ETF and fund format. Thank you so much for watching. Please remain glued to Business Today Television. There's a lot happening on the other side of this break. Thank you very much.
Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra. Well, it's raining IPOs on the D Street. As many as 14 IPOs eyeing over 9,000 crore rupees have already opened this week or are about to open, and you as an investor have got this massive opportunity to invest in any or all of these 14 IPOs that are making their debut on the D Street pretty soon, making it one of the busiest weeks for primary offers in recent years and definitely the busiest week for IPOs in this year. Together, all these 14 IPOs are already aiming to raise over 9,000 crore rupees. Out of these 14 IPOs, 4 are already open right now and where you can actually currently invest.